Sources of cash. Cash is considered to be the lifeblood of a business. Cash shortages can be stifling and expensive, while excess can lead to poor returns. Since most businesses do not function on a pure cash basis, it's critical for them to forecast their needs for cash in advance. The cash budget is an analytical tool that estimates the future timing of cash flows and inflows and outflows and projects potential shortfalls and surpluses. Our cash inflows and receipts include cash sales from products and services, accounts receivables, cash sales of equipment and other assets, and funding sources such as bank loans, bond sales, and stock sales. Cash uses include cash purchases of supplies, inventories, raw materials, accounts payable to our suppliers, wages and salaries, rent, leases and mortgage payments, utility payments, shipping costs, interest payments, dividend payments, paying of debts, and the repurchase of stock. This list can serve as a guide when preparing our cash budget. Since sales revenue is the base variable driving almost all other items in the cash budget, it is important to forecast sales as objectively as possible. Since there is usually a time lag between when a sale is made and when the cash is received, keeping track of when the firm receives cash from sales is important when determining is important as determining when the sale materializes. Companies use internal data as well as external data to come up with objective forecasts for sales. Cash inflows from sales. Firms typically sell products and services partially for cash and partially on credit. Thus, an analysis of the firm's collection policy can help project cash inflows from sales. Managers often figure in a small percentage of the forecasted sales as bad debt when preparing cash budgets. Besides sales, which is the main contributor of the firm's cash inflows, the timing and magnitude of other occasional sources of cash, such as asset sales, funds raised through the issuance of and sale of securities, and income earned on investments, must be forecasted when preparing a cash budget. Cash budgeting, although critical, is only one aspect of short-term financial planning. In addition, it is important for the firm to forecast their operating cash flows and net income from the forthcoming period by developing pro forma financial statements. There are a variety of ways to produce pro forma statements, but the statement usually relies on two primary inputs: the prior year's financial statements and the relationship of the account balances to each other, and the projected sales for the coming year. The percentage of each item, either to sales or to total assets, is computed for the prior year and then multiplied by the projected sales or total assets for the coming year to develop pro forma financial statements. A pro forma financial statement. Each statement item is expressed as a percentage of sales. The pro forma income statement is developed by multiplying the percentage of each item to the sales by the forecasted sales for the next period. This approach, although a good first step, can be considered too simplistic in reality because many financial statement items do not vary proportionately with sales. In particular, depreciation decreases over time and cost of goods sold often declines due to the economy of scales. The manager would have to fine-tune the forecasted values to make it more in line with their reality. pro forma balance sheets. To develop the pro forma balance sheet, a similar procedure is used. Each prior year's balance sheet item is expressed as a percent of the total asset and then multiplied by the forecasted total asset figure for the next period. Items which are obviously either consistent each period or which vary at a different rate for whatever reason are accordingly adjusted by the financial manager. If total assets exceed total liabilities and owner's equity, external financing is allocated according to some predetermined ratio to serve as a plug variable. The cash conversion cycle. So in order to manage working capital efficiently, a firm has to be aware of how long it takes them, on average, to convert their goods and services into cash. The length of time is formally known as our cash conversion cycle. This cash conversion cycle is made up of 3 separate cycles. The production cycle, the time it takes to build and sell the product. The collection cycle, the time it takes to collect from customers. And the payment cycle, the time it takes to pay for supplies and labor. Therefore, the cash conversion cycle is equal to the production cycle plus the collection cycle minus the payment cycle. The production cycle and the collection cycle together make up the operating cycle. So the cash conversion cycle can also be calculated as the operating cycle minus the payment cycle. The production cycle begins when a customer places an order and ends when the product is shipped out. The collection cycle begins when the order is filled and ends when the payment is received. The payment cycle begins when labor is hired or raw materials are received to start the production and ends when the firm pays for its purchases, raw materials, and other production costs. Since firms typically have to pay production costs before they receive payment from their customers, a longer cash conversion cycle would tie up their finances and vice versa. It therefore makes sense to track all of these various cycles and try to shorten the cash conversion cycle so as to free up as much funds needed. The average production cycle is calculated in 3 steps. First we calculate the average inventory as the beginning inventory plus the ending inventory divided by 2. We then take that average inventory and divide it into the cost of goods sold, and that will determine our inventory turnover rate. Lastly, we take that 365 days and divide it by the inventory turnover rate, and that will give us our production cycle. Our collection cycle, or our average collection cycle, makes up another leg of the operating cycle, and it measures the number of days taken by a firm on average to collect its accounts receivable. So first we calculate the average accounts receivable by adding the beginning accounts receivable to the ending accounts receivable and dividing by 2. We then measure the accounts receivable turnover rate by taking credit sales and dividing that by the average accounts receivable. That turnover rate is then divided into 365 days, and that will give us our average collection cycle. Our average payment cycle is also calculated with the same 3 steps, except we use the average accounts payable and the accounts payable turnover to do so. When we add the firm's production cycle to its accounts receivable cycle and then deduct the number of days in its payment cycle, we get the cash conversion cycle, which is the number of days between when a firm incurs an outflow to start production until it receives a payment on a credit sale. So if a firm can shorten the production cycle or its collection cycle or both while keeping its payment cycle constant or lengthened, it can shorten the number of days that it would typically have to finance its operation, thereby reducing their financing costs and increasing their profits. Thus, shortening the cash conversion cycle essentially requires the efficient management of receivables, which includes the credit policy, inventory, and payables. Now, managing the accounts receivable and setting that credit policy. The efficient management of accounts receivable is a critical step to shortening the cash conversion cycle. A firm's credit policy, if it is too lax, can increase defaults, and if it's too strict, can lead to lost sales. Thus, firms have established a well-balanced credit and collection policy to efficiently manage working capital. The timing of collecting payments from customers is hardly uniform. A certain percentage of customers always pay on time, while a small percentage always pay late. Hence, the firm has to analyze their historical collection patterns and accordingly plan for their future. Credit. One firm's accounts receivable is another firm's accounts payable. Also, the cash conversion cycle decreases with a shortening of the collection cycle, but increases with the lengthening of a payment cycle. So if a firm shortens its collection cycle by tightening its credit policy, its suppliers could do the same, which would negate the effectiveness of the strategy. Excuse me. It is imperative for the firm to establish a good credit policy requiring screening, payment terms, and collecting of overdue bills. Qualifying for credit. This often depends on the customer's background, business potential, and competitive pressures. There is usually a trade-off between paying the high screening costs and the lost cash flows due to defaulting resulting from poor screenings. An important part of the credit policy is to determine how many days of free credit to grant its customers, or whether or not to offer discounts for paying early, and if so, how much of a discount. Discounts, if high enough, tend to be mutually beneficial, since the seller frees up cash and the buyer pays less. Now, collecting overdue debt. A firm's collection policy involves sending collection notices, taking court action, and eventually writing off bad debt. The cost of the firm escalates at each step. Firms should carefully establish and monitor their credit policy involving screening, payment terms, and collection procedures so as to maximize the benefits while minimizing their cost. Now, the float. The float, which refers to the time it takes for a check to clear, is of two types. There is the disbursement float and the collection float. The disbursement float is the time lag between when a buyer writes a check and when the money leaves their account. The collection float is the time lag between when a seller deposits the check and when the funds are received in the account. The collection float is a part of the disbursement float, so if the seller or his bank can speed up the collection, it will automatically shorten the disbursement float. Speeding up that collection, shortening the lag time, the firm attempts to speed up the collection in a variety of ways, which includes locked boxes, which are post office boxes set up at convenient locations to allow for quick pickup and deposit of checks by the firm's bank. And then electronic fund transfers, which occur directly from their buyer's bank account. For example, the accepting of debit cards. Slowing down payment or lengthening the lag time is getting more difficult with the advent of Check 21. the electronic clearing of checks between banks, and the acceptance of debit cards. One method that continues to be popular, though, is the widespread use of credit cards, which allows for a month-long float. Financial statements can provide vital information for managers and analysts if they know how to organize the mess of the numerical data into a meaningful format that can be used to analyze and interpret the performance of a firm. Just like a doctor takes a look at the patient's x-rays or the CAT scan when diagnosing the health problems, a manager or an analyst can look at a firm's primary financial statements, the income statement and balance sheet, when trying to gauge the status or performance of a firm. As explained in earlier chapters, the income statement provides a periodic recording of the sources of revenue and expenses, while the balance sheet provides a point in time, a snapshot of the firm's assets, liabilities, and owner's equity. The financial statements by themselves constitutes fairly complex documents involving a whole bunch of numbers. The values are absolute in nature, and although they tell us something about the amount of assets, liabilities, equity, revenue, expenses, and taxes of a firm, unless they are benchmarked against some standard, it is difficult to really gauge what's going on, primarily because of the size and maturity differences among the different firms. One common method of benchmarking is to compare the firm's current performance of that of its own performance over a 3 to 5 year period. We call this trend analysis. By looking at the growth rate in the various key items such as sales and costs and profits, we can determine if the company is improving, strengthening, or retreating. Another way to make some sense out of the numbers is to recast the income statement and balance sheet into common size statements by expressing items on the income statement as a percentage of sales and on the balance sheet as a percentage of the total assets. Benchmarking is a good point to detect trends in a firm's performance and to make a quick comparison of key financial statement values with competitors on a relative basis. However, a more in-depth diagnosis requires individual item analysis and comparisons, which are best done by conducting ratio analysis. Financial ratios are the relationship between different accounts from the financial statements, usually the income statement and the balance sheet, that serve as performance indicators. Being relative values, the financial ratios allow for meaningful comparisons across time between competitors and with industry averages. The five key areas of performance in the financial ratios include liquidity ratios, solvency ratios, asset management ratios, profitability ratios, and market value ratios. Liquidity ratios are short-term solvency ratios. They measure the company's ability to cover its short-term debt obligations in a timely manner. There are three key ratios. They include the current ratio, the quick ratio, and the cash ratio. The financial leverage ratios, or the solvency ratios, look at long-term solvency. They measure a company's ability to meet its long-term debt obligations based on its overall debt level and earnings capacity. Failure to meet an interest obligation could put the firm into bankruptcy. These ratios, three key of those are the debt ratio, the times interest earned ratio, and the cash coverage ratio. Leverage must be analyzed as a combination of debt level and coverage. If a firm is heavily leveraged but has good interest coverage, it is using its interest deductibility features of taxes to its benefit. Having a high leverage and low coverage could put the firm at risk of bankruptcy. Now, our asset management ratios measures how efficiently a firm is using its assets to generate revenue or how much cash is being tied up in other assets such as receivables and inventory. We have 5 key asset management ratios: inventory turnover, days sell in inventory, receivables turnover, days sell in receivables, and total asset turnover. Profitability ratios such as net profit margin and return on assets and return on equity measures the firm's effectiveness in turning sales and assets into profits. And market value ratios are used to gauge how attractive or reasonable a firm's current price is relative to its earning, growth rate, and book value. These include earnings per share, price to earnings ratio, price to earnings to growth ratio, and market to book value. Potential investors and analysts often use these ratios as part of their evaluation and analysis. Typically, if a firm has a high price to earnings and a high market to book value ratio, it's an indication that investors have a good perception about the firm's performance. However, if the ratios are very high, it could also mean that the firm is overvalued. Now, the financial statements of publicly traded companies and industry averages of key items provide for raw material for analysis and investors to make investment recommendations and decisions. Oftentimes, you will see we will take different industries, such as Coca-Cola and Pepsi-Cola, and do a comparison of those performances. We can then, in turn, compare our solvency ratios, our liquidity ratios, our profitability ratios to better determine which company is more efficient and more effective.